the scale of what needs to happen longer term. I mean, think bigger picture. If we're moving towards a net zero over the coming decades, this isn't a few billion we're going to need. We're talking hundreds of billions to be spent in mining projects.
We still think that there's a real possibility of some seriously higher prices amongst these metals, and not just copper or lithium, but also across the wide range from nickel to cobalt.
Once you apply this extra level of the concern for the E and the S especially, it is going to make it even tighter.
I think that you can definitely produce a product that commands a premium in the marketplace. Absolutely.
Hello to viewers tuning in to this virtual discussion on 121 mining investment EMEA online. We're going to be tackling the defining theme for metals and mining, perhaps for this decade, around the energy transition and decarbonisation goals, and how we're going to get there with the natural resources required to meet ambitious government and corporate targets. So here to tackle some of the pressing issues and the various investment approaches within this global movement, I've got a stellar panel of experts with me, comprising of James Hayter at Baker Steel Capital Management's Electrum fund, Will Smith, who is CIO of Westbeck Capital Management, Simon Gardner-Bond, CTO at TechMet, and Michael Insulán, who is Vice President Commercial at First Cobalt Corp. So, gentlemen, thanks very much for joining me for this discussion. James, I wanted to turn to you first, and just wanted to get an introduction of the Electrum fund, actually, as this would be the first time I think we will have covered that within one-to-one content, and then also ask you, what does the energy transition mean to you as an investor focused on the metals and mining sector?
Right, so we set up the Electrum fund 2 years ago with a mandate and a belief that that was an appropriate vehicle to take advantage of the major secular changes that we're seeing in the global economy, namely the push to decarbonisation, which you talked about, as well as the gradual, or maybe not so gradual, debasement of fiat currency. So we're a diversified mining fund which has a focus on strategic and future-facing metals in place of iron ore and coal. So we launched the fund 2 years ago. It's been very successful, both in terms of return and managing to grow its AUM, and we think there's a strong future in that sector over the coming decades, as you talked about. In terms of how we see the sector developing overall, well, I think everything's happened a lot faster than we thought it was going to a year ago. COVID has really pressed the accelerator button on EVs and also renewable energy, and really the world has a chance here to build back better, and it seems to be grasping it, particularly in the US. The amount of stimulus that we've seen there has definitely been a surprise, and it's really accelerated our own projections on where demand is going, and we were certainly on the bullish end of those forecasts a year ago. So this has always been an exciting space, but I think the speed of that transition has really accelerated, and that has profound implications for the metals markets, because suddenly that becomes a bottleneck, particularly when we talk about the capital that's needed and just the time that's needed to bring some of these metals and some of these mines to market. So particularly around copper, which is probably perhaps the most well-known, you're looking at a good 10 years there to bring a lot of these sort of major mines to market. And we've seen a reflection, that being reflected in the price action. But I think there are also a number of smaller metals that people have really overlooked, and where that supply constraint could become critical in the coming years, if not months. And we could be in for a really interesting ride over the coming decade.
Yeah, certainly. So a lot of supply tightness coming as we transition. But so how's the fund position to sort of capitalize on that? Do you take a sort of a broad position on a segment of commodities within the battery metals complex that you think are going to perform well, and then within that, you're holding mining companies of a particular size, that sort of thing?
Yeah, I mean, so overall, I would make the point that the best opportunities always come from a great deposit, and that bottom-up fundamental analysis at the asset level underpins everything that we do. If the deposit isn't right, we won't make the investment. If the management team isn't right or the capital structure isn't right, we won't make the investment. We're investing in the equities, we're not investing in the commodities. That being said, there is obviously a great deal of top-down analysis that dovetails with that bottom-up analysis that we do. And we have our favorite commodities. We obviously have long-term and short-term pricing projections, and that makes a big difference to where our DCF analysis goes, looking out and how attractive the valuations of these companies look. At any one time, what we broadly say is we'll be between a third and 2/3 invested in either specialty metals or precious metals, and the weighting there will depend on obviously how bullish we are in those particular sectors, but also where we see the most fundamental value from a bottom-up asset allocation. At September last year, we were heavily overweight specialty metals, probably slightly above that 2/3 area that we looked at, and now that's paired back slightly with the outperformance of some of the specialty metal sector and the relative valuation of some of the gold miners catching up. I should say that within the precious metals, we put a silver into that basket, but I think we can probably talk about that later on. That's a bit of a hybrid between the two, I would say.
Yeah, it's interesting. Silver's sort of evolving role now, but just coming back to your approach from what you said in investing in the equities and really scrutinizing the company rather than just taking a commodity pick. How have the companies been performing? Are you broadly happy with the sort of the junior tier of mining companies in terms of their capital discipline and the way they've progressed projects as well? And as a shareholder, what's your view on the companies?
Yeah, I mean, we're mainly invested in the producers, and we like to see a clear pathway towards shareholder returns, either through dividends or shareholder buybacks. That's the area of the market that we tend to concentrate on. I would say we always make mistakes. It's not been a perfect track record over 2 years, and there's some companies we've invested in that haven't been able to do what we thought they'd be able to do. But overall, we have been happy with the companies in the sector. I would say that overall, the mining industry seems to have learned its lessons from the last cycle, and we have seen a much improved capital discipline. We have the mergers and acquisitions that we've seen. I would say more than 80% of them we have been happy with. They seem to have added shareholder value, and that has been impressive. Obviously, it hasn't always been the case, but touch wood, so far we have seen that capital discipline being maintained. I do think at the back of my mind, or wonder how much of that is due to COVID and management not being able to travel, and that being curtailed as a result of it's kind of an enforced discipline rather than a self-enforced discipline. But no, overall, I've been happy with the way things are progressing, and things always look better with higher prices. And obviously, we've seen much higher prices over the last 6 months in many of these areas, and that always helps. But no, I think management generally the discipline's been good, and the companies have performed well. Yeah,
it's interesting. We could talk a bit more on M&A later, but could there be a absolute wave of M&A coming once international travel and on-site due diligence is allowed to pick up? We can touch on that in a bit. Will, could I turn to you as another shareholder on the panel and ask you about your fund with Westbeck? Do you share a similar view with James? You've been in this space looking to capitalize on the energy transition for a while, and as far as I understand, you look more than just the mining companies. You invest across the value chain. Is that right?
Yeah, we invest across the value chain, but clearly we've got a very large weighting, over 50%, into the critical materials that we actually see as being one of the major constraints to the energy transition, the availability of these materials. And I think, as everybody knows, we're not dealing with the likes of iron ore here that you just dig up, wash, put on a boat. These are materials that have to be concentrated and refined to within an inch of their life before they enter into a car battery or a wind turbine, etc., etc. So this all adds to the complexity and the difficulty and the cost of producing these materials. So it is a very different type of resource investing. And indeed, it probably is a speciality material investment that we're dealing with here. At Volta, we look at all aspects of the value chain, and for the first 6 months of the fund's life, we were short the raw material stocks simply because prices were still falling, and a lot of companies were going through that difficult time of commissioning. That was over 2 years ago. The fund's been going for over 2 years now, and but clearly right now, post-COVID, we are broadly bullish. The wider commodity sector, which hasn't looked better than it has done for a while, I'd say over 10 years now. You've got these coordinated stimulus package around the world as the policymakers tried to recover from the shock of the pandemic. And at the same time, you have seen over the last 10 years enforced discipline on mining companies, which were very busy in the first decade of this century building new capacity. We have not seen that for the last 10 years. So you've got a very different setup. And also coming down the line, you've got this massive demand shock coming at you from the materials required for decarbonisation, for the electrification of transportation, anything to do with electricity, whether it's generation, transmission or usage, demands large amounts of copper, for instance. And I think James touched upon the length of time it takes to put a new copper mine into production, 8-10 years. And yet we're seeing on the demand side a capital unconstrained demand sector. When I look at the ease and the ability of the EV companies, the standalone EV companies, maybe helped by the SPAC initiative in the US, these guys are able to raise huge amounts of capital, which eventually will filter down into demand. Now, I think to the joy of all resource brokers everywhere, this year has seen the ability of resource companies to also raise capital, but it is nothing like the amount that the end users are able to raise. And in many cases, this capital is being raised to finish studies, to do exploration. So much of it is not yet going into new productive capability. So this is where we're seeing, we still think that there's a real possibility of some seriously higher prices amongst these metals, and not just copper or lithium, but also across the wide range from nickel to cobalt. We're going to see some real demand shocks here. And I think it's one of the big issues for the energy transition, that capital has got to be diverted into this speciality material sector a lot more than it has been in the last 6 months.
Yeah, certainly. Would you say that it's going in the right direction though? You know, sort of wider recognition, perhaps for mining, that's come out of this green movement, Biden's administration, the EV sector sort of boom, or all that capital going into SPACs that you say. Do you think that that's, you know, a positive for the downstream part, and it will eventually trickle into mining companies?
I think there's an appreciation, and certainly we're seeing an appreciation, that you have to start off with mining. And for 10 years, it's been a tough place to be a resource investor, in terms of you've had falling prices. And quite frankly, the generalist investor has not needed to be there He's made his money out of tech. Now, tech will still be a great place going forward, but we've seen this sector been capital starved for a period, and now there's a realization that we're going to have to put together some big increases in productive capacity, and that's going to require a lot of capital, and it's going to have to get returns on that capital. So we're getting a lot of incoming calls now from investors going, look, can you help us through this phenomenon? We recognize that there's a problem arising. It requires capital. Where should it go? So yeah, there's a growing realization that there is money to be made in this space. And that is a big change over the last 10 years as well.
Yeah, certainly. But it's good that there's recognition is coming. Okay. Michael, could I switch to you? And you joined us in a new role from last time you spoke with us. You were with ERG and now you're with First Cobalt. What's your view, based here in Europe, but working for on the corporate side now? Is the capital starting to come through? Are there broader conversations or wider recognition from newer investors at all?
Yeah, I think there is a strong increase in interest. In particular, if you look at potential production from areas in the sort of Atlantic region. So, where do we see the increase in EV production and battery cell manufacturing? It's really China, of course, and South Korea and Japan, but they are pretty well financed already. Where we don't have as well financed projects is in the Atlantic region, Europe and North America. At First Cobalt, so just as a quick explanation, I've joined Adam and the panel on previous events. On the previous event, I worked for ERG, Eurasian Resources Group, which now operates the second biggest cobalt mine in the world. It's a great company. But the fact is that as anyone operating a cobalt mine in the DRC, the options to export are very limited. 80% of the cobalt that goes into the battery supply chain travels through China. And I think that even in the short term, the European and North American precursor makers and cathode makers and battery makers and EV makers, they to some extent probably want to have the supply chain localized in North America or Europe or the Atlantic region in general. So I do see huge amounts of interest to at least hear us out. I think First Cobalt is probably one of the most exciting companies out there. There's a lot of interesting companies, but I joined First Cobalt because I do see it as the most exciting company out there in the battery space. We'll see if this translates into sort of a better financed industry or not. The interest is certainly there, and we're doing our best to inform investors about what we're doing and what the industry, what we think the industry needs to do in order to develop in North America and Europe.
Yeah, absolutely. And you're, a tough question here, but around the evolving battery mix, do you see it fragmenting and Cobalt still having a significant part to play within certain battery mixes within electric vehicles, as opposed to it going down one route whereby a certain metal or commodity will be substituted out, and that will be the new industry standard, for instance?
I think, there are a handful of different battery chemistries that can be used in electric vehicles. It's NCA, it's a variety of NCM batteries, it's LFP, and then there's a variety of LMO or LMNO or LNO batteries. Now, the ones that don't contain cobalt is the LFP and potentially some variants of the LMO batteries. There's no problem applying these in cars if you want a shorter range vehicle, ultimately. They will be cheaper, but they don't apply everywhere. And if you look at the Tesla battery day or the Volkswagen power day, they did stress that they will still use high nickel and cobalt batteries in a variety of vehicles. So I think the industry will essentially segment. There's a place for every battery out there. But the fact is that the sheer volume of new electric vehicles that we'll see on the roads over the next decades is just going to lift most of these battery materials.
Yep. We'll come on to that. That's one of my questions for a bit later, based around, expectations on penetration or uptake of electric vehicles versus the material supply. But we'll dig into that a little bit more. Simon, could I just turn to you and get your commentary on some of the things we've touched on already? How do you see capital coming into the sector as both a financier and someone who works very closely with mining companies in your the mining companies that you finance? Are they getting as much love as required?
Yeah. Well, I think it's interesting. I think it's interesting to hear Will say that there's definitely some interest coming in. There's definitely interest. There's interest in general, I think, but and we've had a lot of interest. We've had a lot of interest of people making investments into TechMet. So, and that really has picked up a lot over the last 9 months, more than I've been here about 2.5, 3 years. So, yes, it's definitely the interest level has picked up. But I still think that the capital markets, the public capital markets for mining in general, and even this space, are going to be very, very difficult. Will touched on the point earlier that, generalist investors just haven't needed to have any exposure. Time was in the last super cycle that, and I think I've talked about this on one of your panels before, Adam, but last super cycle, if you didn't have exposure to resources, you, as a generalist, you were in trouble, because there was many basis points of your index were generally going to be resources. And so if you didn't at least cover yourself, you were going to underperform, whether you liked it or not. So you were kind of bound to show an interest in at least the majors. The rise of, even if they haven't done terribly over the last sort of few years since the super cycle, the resources sector has recovered. Everything else has done so amazingly well, and Will mentioned tech, biotech, just consumer, consumer retail, and they have all risen to the point where resources is just such a tiny part of the benchmark still, that if you, my experience, and this is how I see it at the moment, if there's even a very good resources play, and it's going to go out there to the public markets today, I still think it's going to be very difficult to get generalist interest because of the uncertainty and volatility of commodity price forecasting. And, to a certain extent, the specialist resources sector has been a little bit decimated. James is still doing fantastically well. That's great. And Baker Steel are still there. And there's a few people, but by and large, that has shrunk. That has shrunken in size. So you can't rely on those guys to fund all of these projects. And besides, they often, if places like BlackRock and Investec will have to have, not Investec anymore, is it? They have to have exposure to, the iron ore, the copper, the energy, the ags as well. So their appetite for these really small sectors, rare earths or cobalt or even nickel, they're really small, and so it's very difficult to get exposure to them. So I just think, and then on the other side, where is capital going to come from to really push some of these projects? Maybe is it going to be from the majors? And I mean, the commentary that I see from them, from the Rios and the BHPs of this world, is that they still seem to be very gun shy, having made really poor capital allocation decisions after the last super cycle. I think there was, I can't remember which one it was, forgive me, if it was either BHP or Rios of the last results. I saw a comment that they were sort of considering, the board considered whether they should sort of start to turn a little bit more, build versus, dividend. And they've decided, they've made an active decision to sort of put that off for another quarter or another half. And they're just going to get left behind, which is great for me. It's great for TechMet. We'd welcome the opportunity to make those investments in these opportunities that they pass on. But I think if you're looking in the public markets, I think it's still going to struggle. Yes, the rhetoric and the news flow is a lot more than it was a year or 2 years ago. But there is still a huge amount of skepticism around natural resources, and that's essentially what these projects are.
Just picking on one of the things you said there around the majors, just maybe this is a unique case, but Rio Tinto had acquired a scandium asset, I think, in Canada, and you know that's not traditionally in their remit.
It was an existing asset. It was an existing asset that they can get scandium from.
Okay.
So they've kind of decided, and that's, you know, typical of your low risk.
Yeah.
You know, it's like BHP looking to expand its nickel assets that they already have in their portfolio. It's better the devil you know than trying, you know, don't go and buy a huge coal deposit in Africa and, you know, and lose your underwear.
Yeah. Low
which
risk.
They've done.
They recognize the value of the material, you know, that's something.
Well, it's like it's a little bit like, you know, Glencore a couple of years ago touting its cobalt as being groundbreaking when it's mostly, or was mostly, a product of its copper production, and great, but it became a, you know, a material part of their revenue and EBITDA, and so why shouldn't they shout about it? But it wasn't as if they went out, you know, a number of years ago and said we're going to be dominant in the cobalt side, you know, sector. It kind of came about because they're big in the copper sector, and you know, and so a lot of this cobalt coming from the nickel and cobalt mining, it's a bonus for them. But are they going out there actively looking for new cobalt discoveries? Well, a lot of them, to be honest, are too small to move the needle for the really big guys.
Well, coming to the other point around this, pausing on growth and returning dividends to shareholders, of which we've seen a fair bit in the precious metals space. I'm not too sure about the technology or transition metals miners. But I don't know, James, if you've got a view on that as a shareholder, have you been you know, happy with the sort of growth to returning cash balance at the moment? And do you think that we're going to suddenly see a splurge of M&A to sort of counter that underinvestment in new projects, perhaps?
I think in the gold sector, yes, we have been happy. We like that increased focus on shareholder returns. That's important to us within the strategic metal sector as well. Just that's the end of the market that we focus on as a fund. I would say, though, that the increases in demand that we're seeing in these technology metals make development stage projects there a lot more attractive, you know, and sort of certainly the return that you could expect on a lot of these projects, you know, we'd be supportive of some of the majors developing them. So there's obviously numerous examples we could talk about in the lithium space where we've been supportive of expansions in the nickel space. Likewise, I think that we are quickly, though, going to run into bottlenecks, and Simon and Will have both talked about the fact that there is a looming shortage, and there are supply deficits that we can see, and there just isn't time in a number of these metals to bring these to market. And it's not just going to be your resource sector specialists like ourselves that can fund these projects. The industry, the scale of what needs to happen longer term. I mean, think bigger picture. If we're moving towards a net zero over the coming decades, this isn't a few billion we're going to need. We're talking hundreds of billions to be spent in mining projects. I mean, it's phenomenal the amount of capital that really needs to be spent in this sector to do this properly, and we need a real change in outlook overall. And we can be part of it, and you know, other specialist resource investors can be part of it. Generalists needs to come in, but there needs to be a recognition throughout the supply chain of what needs to happen here. So battery manufacturers need to come in, car OEMs need to come in, utility companies need to come in, other financing agencies need to come in as well, and green bonds will probably play a role as well. And the industry as a whole needs to rethink how it's financing itself. It's not going to be, could be talked about. Yes, I think 10 years ago it was an unloved sector. The returns have been terrible since. that when people are now beginning to realize that we do need these metals, but we need to now come forward and say, look, it's not just about needing the metal. What can we do on a sustainability and an ESG basis to make people feel more comfortable about investing in this sector? And we haven't done that as an industry yet. We need to come together and get some common standards and work towards that across the supply chain to make people feel more comfortable about where they're investing and make people feel good about investing in this sector again, and give them the returns and not neglect, paying dividends and the shareholder returns, because otherwise, why are we doing it? We're investing in this sector because we want a return on it. So we've got to do it all, and we've got to do it all fairly quickly, because the changes are happening very, very fast. As I said, much faster than it happened a year ago, and these mines take a long time. So I think we've got to think a little bit bigger and speed up the process, and shareholder returns are part of that. People need to make money, and if we neglect that and we wait too long, then prices are going to spike. And we've seen it before. We've all been around a while. We all remember various price spikes, whether it's rare earths, whether it's cobalt, whether it's rhodium again, and it isn't good for anyone because it doesn't help the industry grow. So the more we can plan and come to a reasonable solution, the better the industry and indeed the entire value chain is going to be.
Yeah, it's good for traders, James. That's about all the only people that it's good for.
It's a point well made, Simon.
Yeah. The point that James is making there about the ESG, I think is really interesting, because it's not something. So we have our own sort of supply demand, outlook, right? And I'm sure everybody does, and there's loads out there. But what is very difficult to quantify is how much more difficult that will make it. So we're talking to, we have some producing projects and we have some development projects that are going to be producing these metals and chemicals for, EVs and renewables, sectors where people are actually very concerned about the traceability, the environmental footprint of the materials that are going into the product, which has never really happened before. Nobody's really bought an air conditioning unit in China and said, where's my copper come from, right? So we are getting like a lot of questioning on this and we have very high standards, and we've sort of our responses, we have very high standards for our operations. Here is the framework by which all of our companies are going to have to abide by. Now, if you apply that across the whole industry and the whole supply of lithium and cobalt and nickel and rare earths, it's very difficult to quantify how that demand curve will look if you apply that over, because I don't apply it. I just take I don't think you can at the moment. It's, I'm just sort of saying, well, these projects are out there and some will come to fruition, some won't, and some will need a certain price to break even. We've all done that for a long time, so we can do that. But to say, once you apply this extra level of the concern for the E and the S especially, it is going to make it even tighter.
Yeah, I would absolutely agree with that, Simon. And I would suggest also, with the focus on having secure supply chains, that the geographical areas of interest are changing a little bit too. Are we saying that there's a premium on European projects? Well, we haven't seen it yet, but it's certainly something that's under consideration, because there is no doubt that the end consumer is driving these ESG concerns all the way down the value chain. We've seen this from the likes of Burberry, making sure that their cotton isn't coming from any areas that slave labor is involved. And I think we're going to see this ripple across the whole area. And I think it changes the geographical areas of interest for resource investors, and some deposits that may have been marginal in the past, they could come back into focus if they tick all the correct boxes for the consumers in the value chain.
I think that's a great point. Well, something that we talked a little bit about earlier, Michael, about referring to the cobalt and the precursors there being 80% of the cobalt precursors that are made in China. I think that's also going to become really important. It won't just be where the deposit is. It's, well, okay, you've got a natural deposit, you've got a natural graphite deposit. That's great. where's that going to be treated, and where's my anode going to come from, and or if I'm producing a lithium and spodumene, well, okay, that's great as well. But if that's going into China, my security of supply hasn't really increased the same as rare earth. So it's not just going to be enough to have a deposit. Can you fully integrate that to a product that's actually going to go into the wind turbine or go into the battery? And I think that is going to increase the level of capex a lot more than what I think the industry has so far factored in. I think that's a really good point to make.
Would there be a premium on certain resources then, or certain supply chains for materials that have met all of these criteria? You know, sort of ESG premium on cleaner nickel, for instance, or is it simply a case that supplies too?
Ask Michael. Let's see if we can get him to spill the beans. Now he's left ERG.
Yeah. Michael, Canadian Cobalt is coming at a premium over.
I mean, everyone's aware of this. We've been in the industry for quite a long time, and there's been talk about premiums in a variety of different sectors based on generally better environmental credentials. And the biggest one that has been largely established or is on the way to be established is probably in the aluminium industry, right? Now, I think for battery materials, for sure, there is strong potential to develop product groups with in particular stronger environmental credentials. I mean, if you ship, and James said it very well, the battery supply chain is quite long, and you have to look at each stage of the supply chain, how companies are processing, if they're following ESG rules laid out by the end-use clients. And on the environmental front, in particular in China, vast majority of precursor and primary refiners of any battery raw materials, they're still thermal coal based. So if you have, like, first Cobalt, which is a hydrometallurgical plant fed by hydroelectric power, certainly, I mean, the negative externalities are lower, so you don't incur any environmental or certainly lower minimal environmental costs. Should that product command a premium? I think there is strong potential for that, absolutely.
Adam, can I ask him directly? Because I know you're going to be a lot more subtle about this.
Tactical.
Come on, Michael. A ton of Cobalt product, whatever you decide it will be, that comes out of Canada, would you? Let me ask a two-part question. Would you be able to sell it for more money, higher price today than the same product coming out of the DRC? And if the answer is no, what about in 5 years' time?
Well, we're still a year and a bit from production. So
that's why I'm saying theoretically, right? Today, if you had product and you coming from that source, Canadian source, green power, if you had that ton and then you had that ton coming out of Congo, is there a financial difference today or not? And and how do you think that will mature?
I think we would look to produce a premium product, and the premium product should be slightly pricier than a regular product, indeed.
And do you think that will change over, like, drastically or maybe incrementally over the next few years?
I think so. Not drastically. You can't be silly about these things, but I think that you can definitely produce a product that commands a premium in the marketplace. Absolutely. I mean, look, the cobalt in particular, and nickel to a large extent, and lithium as well. I mean, they're commodities in some senses, but they are quite dissimilar. I think James and Will was talking about it as well. That's, they have to be refined not only to perfect specification, but also according to very strict ESG guidelines. So yeah, I think there will be differentiation similar to what we've seen and what we are seeing in aluminium. We'll see this in steel and a lot of bulk commodities as well. When it comes, for instance, with the introduction of, I think we're on the cusp of it, the introduction of the, say, hydrogen-powered aluminium smelters and steel mills in lots of parts of the world, and particularly in sort of the Western world, Europe and the US. I think that in the long term there will just be a premium paid for these products, and essentially what the clients are paying for is to lower global pollution. And I mean, if you think about this from the opposite perspective, I mean, I think we're moving into a world where people have to pay for polluting the world. That has a very positive impact, that people stop polluting as much. They will keep it to the bare minimum. But the second thing is that obviously the margins of a refinery long term, like for the first Cobalt refinery, with near zero emissions, zero greenhouse gas emissions when it comes to the actual processing of the raw material, we will be in the long term a much less costly operation than a thermal coal power plant.
Yep. Excellent. Drawing on one of the points you raised there, it's about the product at the end as well as the process to get that. And I think, Will, you touched on it as well, the amount of refining and metallurgy, chemistry, that goes on making these products battery grade. That might create a differentiation in terms of the price of the product. Porsche, for their high-end, high-performance electric vehicles, are going to want a certain quality of battery that maybe a smaller, cheaper Chinese EV isn't necessarily going to want that same quality of materials input, and that's where you'll get the price differentiation. Is that a fair assessment, do you think?
Yeah, I think that's a very good point, and I think that certainly the big German car companies would absolutely love to see a supply chain that was based in Germany, that they could monitor the carbon emissions and be as carbon neutral as possible, and to have that raw material go through all the precursor stages and to have a domestic, if you will, European car industry. I'm not sure that's entirely possible in the short term. I think a lot of people think it will be in the medium term. We'll see. There has to be some big investment here. Is the consumer prepared to pay for that in the top end? I think they will. We've already seen many supply chains absolutely advertise and make a play about their provenance. And I'm sure this is only going to increase over the coming years. So that just won't include the sourcing of the raw materials, but as you're pointing out, the secondary value chain further downstream in the preparation and refining of these materials, absolutely. And I think proximity to hydropower, to clean power is going to be very important for a lot of the OEMs and their customers.
Yeah. And broadly on the OEMs, and this could be to the whole panel if you like, how are they performing within all of this? Because it strikes me that they're in a really difficult transition. Certainly, the automobile companies that are becoming EV companies, maybe not Tesla, who's set off as an EV altogether. They've got this transition going on, which is difficult. And then on top of that, the sourcing of the quality supply, they're in a bit of a tricky scenario themselves. And there's been talk of OEMs coming closer to mining companies. Tesla's sort of talking up, maybe speculatively, owning more of the value chain or owning mines. Do you think this is realistic, or this is just a little bit of hype to get the sector going?
They're all running for their lives, aren't they?
I think a price shock will certainly concentrate their minds, and they've shied away from doing it so far. but I think they're going to have to, not just to protect themselves from prices, but absolute security of supply. So I think they are going to have to start investing in the upstream production of these materials without a shadow of a doubt. A secure contract is one thing, but they've got to invest the capital to secure supply.
This isn't new, Adam. I mean,
Yeah.
car OEMs have been reliant on PGMs for 20 years, and they've been caught offside there a number of times. I mean, Ford back with palladium spike, and that was $1 billion back when $1 billion was a lot of money. It's probably well known that the one car OEM completely ran out of rhodium, had to stop production last year, and they haven't made strategic investments in that space, and it's cost them. And it's not going to be from the buying. My sense, it's not going to be from the buying department that these guys are going to come in and start making investments in lithium mines and making strategic investments. They're not. Their minds don't think that way. It has to come from the top down, saying, look, we are going fully electric in 10, 15 years. There is a clear problem. We don't have enough of these natural resources. I think Volkswagen's Power Day was good in the fact that it outlined the suite of sort of battery chemistries for the next 10 years. So they obviously have a clear idea, but they need to liaise with partners and find a way of financing these projects. I don't think Volkswagen's going to get into lithium mining, and you question whether they should, but certainly they should be partnering with producers and identifying the best resources, and just as Will said, getting that security of supply is going to be crucial to them, because it's a business critical issue. And just like we saw in a different sector with rare earths before, that really hurt a lot of guys in 2011 with those prices, and that can absolutely happen to more materials moving forward, and there will be big losers if that does happen, and the whole industry will lose if that happens. These guys don't change their mindset to come up with a more efficient way of looking at things over this transition period for the next 10, 15 years.
But James, the OEMs have got a massive problem here, because they are not geared up to think about investing in a sector like ours. Their business is huge volume, tiny margin.
Yep.
You look at any major OEM and the margins are, we're all in metals and mining, right? We look at things and we go, has to have a 20% IRR because I know the price, the revenue line is going to be so volatile. I have to make money at some point in its life, right? But, an OEM looking at expanding a new factory or changing a product line or designing a new model, you talk to them about IRRs, they are talking no way more than single digits. And they're lucky to get above 5, right? So when you approach them, and I've personally talked to some OEMs, and
I did the same thing 15 years ago. 15 years ago, I was trying to get people interested with car OEMs, came to site with a clay deposit in Nevada, and trying to talk to them and trying to get them comfortable with the technical risk and the IRR. And it was completely different ballgame. I completely understand your point.
The one problem that I think that they have is, and this, like I said, it is from actually first-hand experience. I've been talking to some OEMs over the last 18 months. They have this ultimate trust that the commodities, they still sort of have this ultimate trust that commodities will be there when they pick up the phone.
Yeah.
And to some extent they are, right? At the moment, if they want more lithium, they can pick up the phone. The market's still relatively well supplied. They want more nickel, they want more rare earths, they can get it. It is, and I think Will just said it's going to be a shock. It is going to be a shock when they phone up and they say, I'm sorry, I literally cannot. I'm your trader and I cannot meet your order. What are they going to do? And I'm talking to them at the moment, and I've been talking to a few of them. They just literally don't even consider this as a possibility. And I think sometimes they look at me like I'm mad when I keep saying, what are you going to do when Tesla's bought all the lithium and you don't have any? You literally, your factory that you've just spent billions of dollars converting is going to have to stop. I don't think they're there yet. Maybe they will. But then to take the next step in terms of an investment criteria I mean, we don't even have to go into the ESG considerations of mining and processing and refining compared to just running a factory in Stuttgart. It's such a different world. So I think personally, I think there's going to be a step in between. So maybe, this is partly, it's not really a stated aim of TechMet, but it might be something similar where there's someone in between who is building assets, building supply, and then providing that to the OEMs with the relevant stamps of, traceability, ESG standards, blah, blah, blah. But for them to actually go and buy mines.
I think you're entirely right. And I think that step in between is probably, certainly in the short to medium term, is probably going to be the cell makers. I mean, we've gone through a few years now where there's been the development of a few very, certainly measured by market share, very successful battery cell makers. And you have seen them become more and more interested in the raw material supply. I think the most recent one was probably CATL buying a stake in CMOC, right? And the Kisanfu mine, which will probably start up sometime in the next decade in the DRC. So I think you see the OEMs, in particular the EV makers, they move in, they take stakes in the cell makers, but with those stakes, it seems as if they presume that the cell makers will manage to source raw materials in the long term. And I think we'll see more cell makers take stakes further upstream, whether it's in CAM or precursors or primary refining or in actual mines.
Yep.
And then on the other hand, of course, you have the primary refiners and some precursor makers taking stakes in the mining industry as well. So, sooner or later, there's going to be more vertical integration here, but which segments buy into which segments has yet to be seen, I think.
Yeah. Okay, that's good. We've got a little bit of time left. I just wanted to get everyone's take on with the way that battery chemistry is evolving as the main demand driver within the transition metals, I suppose. Obviously, copper is very bullish, and I think everyone would say they're bullish outlook on that. But are there other commodities in the near term that each of you think that each of you would be quite bullish on? Just like to get your view there.
Well, I'm obviously very bullish on cobalt. I'll leave it at that.
Yeah.
It would have been a surprise otherwise.
Yeah. No, but honestly, I think I would just like to point this out very briefly. I do think even when I worked at ERG, and that was a private company, so didn't need to do any investment relations and the PR element of it really. But even then, I thought cobalt is really one of the most prominent to be successful in long-term battery metals, regardless of the threats, if you will, of LFP or LMO chemistries. But I would also say this. So first, Cobalt as a company, we're essentially operating two phases here. So we have a refiner, we have a mine project. The refiner will be up and running soon, but we have a second phase to the refinery, which is really to become part of the recycling industry. So we will not only process primary sulfate, produce primary sulfate, we'll also do hopefully a recycling line where we will extract nickel, copper, cobalt, also looking into the other components of the battery cells. So I think, as I said before, exposure to, I think cobalt and copper for me are the strongest. Nickel has potential, but there have of course been quite a few news around the future of nickel recently. So we'll have to see about nickel.
Yeah. And it's interesting you mentioned about recycling as well. That's an area that's surely got to grow exponentially if this industry is to meet the demands and increase investment there, but also technological capabilities. I don't know if anyone else has a view, perhaps on recycling as well.
Well, it's going to meet the demands of the European Battery Initiative, which I think is over 50% by 2025. Michael, don't take this personally. I am very bullish Cobalt, but I'm sure Cobalt is the first metal that people are desperate to engineer out of the battery system. And I'm very bullish of it because for the next 5 years, they absolutely cannot. I think for the next 5 years, Adam, you can be bullish upon all the battery materials, quite frankly. Yep. If there is a technology that's going to change batteries, and there could well be, I don't see it. I think it's much nearer 10 years away than it is 5 years away. Solid state seems to be a rolling 2 years in the future. And any other battery development is a long time in the development, qualification, etc. So I fully take Michael's point, and others may be more bullish on other materials. But for the next 5 years, I think such is the demand shock relative to the supply response. It's a really fascinating place for the investor.
Yeah, interesting.
On the recycling side, Adam, one of our key investments is a lithium-ion battery recycling company in North America called Lifecycle, and that's in the process right now of a SPAC listing. It's sort of all announced and public, and it's tied up, and it's going to be de-SPACing later this year. And so we've been heavily involved in the recycling side of the business, and a few comments on it. I guess I would say that there are many people trying to do it. There's a variety of different technological solutions, a lot of which have very good merits. So I don't think we're going to suffer from lack of recycling. It's a bit of a chicken and egg situation in that right now there isn't the volume of batteries coming out of the market to recycle on the automotive. I did a talk to the UK sort of quasi-governmental institution earlier this week, and they were asking about the UK, and the vehicle sales, the EVs that you'll sell this year won't come out of the market until sort of 10, 14, 15 years hence. So, it's yes, we do need to build recycling capacity, but the volume is in the future. It's not really now. At the moment, if an EV fails and the battery hasn't blown up, there's a competitive price war for that battery because so many people want to study them that if you have a Renault battery, you could put it on eBay and you'll get more for it than you will for scrap because people will want to test it and try the process on it for second life and things like that. So that will come. I'm confident that the recycling industry will get there to be able to meet that demand. But absolutely, it will be a necessary part of the ecosystem, and we're still focused on it going forward.
Yeah, very interesting. Sort of a generational requirement there for enough supply to come online. Great.
Yeah, well, the interesting thing is if you look at it, it's going to take decades. I mean, I keep telling people you've got to be realistic about what recycling could contribute to the system. So, if you take copper, for example, we've been using copper industrially for decades and decades, and it's a very mature market. It's a high value metal. So that has always encouraged a very efficient recycling system, right? And even in the best of times, we struggle to get more than 30% of copper from recycling. So I don't see why, even with the best one in the world, we're going to get much more than that, even with a mature market. And as the EV sales continue to do this, you're always going to lag. So there's going to be 20, 30 years before recycling is making a significant contribution. So what that means, the outcome of that for us as a group is that you will need primary production.
I mean, I would just like to interject briefly on what Simon said. I generally agree with what you say, but I think we got to compare lithium-ion battery recycling a bit more with, say, lead-acid battery recycling, where you have 99.6% of all batteries or something like that are recycled because of the regulatory measures that have been put in place, because you don't want these batteries obviously to just be landfilled. Now, of course, there is a medium to long term issue with recycling of lithium-ion batteries as well, and it's something that both Simon and Will alluded to and pointed out very directly, which is that there is a tremendous potential for lithium-ion batteries to be used in second life applications, whether it's grid installed energy storage systems or for applications that require perhaps less than 80% efficiency. But I still think there is, even in the near term, a fair bit of recyclable material out there, because don't forget, we've had a mobile device industry that has been selling lots of mobile phones and tablets and PCs over the past 2-3 decades already. And there is a fair bit of this material actually coming to market. And I think there's a lot of opportunity to a company like First Cobalt to hydrometallurgically process this material, rather than many of the existing recycling facilities that rely on a pyrometallurgical routes. Li-Cycle, of course, is different. I believe Li-Cycle is hydrometallurgical as well. Is that right, Simon?
Yeah, that's right. And I'm going to counter your point, because I'm talking about global, right, Michael? How many iPhone batteries do you need to make one EV?
Pardon?
How many iPhone batteries do you need to make one EV?
Well, it depends what EV, but a lot.
The answer is a lot, right? Yeah. So
Yes.
that's my point. Is that yes, there are millions of device batteries out there, and Li-Cycle is processing them right now. You know, they're doing that in their 2 active plants in North America. But when you look at it's this volume chart, like if you convert that it's unit sales to tons, you know, devices are this tiny little strip at the bottom, right? And so as the market's going up, so you know, from now, you know, we're selling a few million units of EVs, but if you look at like 2030 and we're selling 30 to 40 to 50 million units. Well, it's only this year's EV batteries that are going to be coming up for recycling, right? So it's going to be a long way away before it's a significant portion of supply.
Yeah, no, I don't disagree with you. I'll give you one final counter, Simon, which is that the vast majority of batteries that are being recycled today will be LCO batteries, because they dominate the mobile electronics segment. So if you're in the Cobalt space like First Cobalt, that's not a bad type of black mass to process.
No, it's pretty valuable.
Okay, we've got about a minute left. I just want to sort of end on a question, probably difficult to say entirely across the mining company tiers, but within battery metals, you know, are mining companies good value at the moment? Are they presenting good value to investors given this demand outlook that we're seeing for most of the battery and transition metals? Obviously, you've got to look under the hood at how the company functions, but generally, are they undervalued?
I mean, from my point of view, what you've got to look at, there's a clear distinction in my mind between the long-term pricing for a lot of these commodities and the volume. You know, I think we all agree that there's a terrific amount of demand coming, but the way the different commodity markets will react will depend upon the scarcity of the metal and the ease of bringing them to market. So something like lithium, there's a lot of lithium around there. You can quite clearly see a pathway to a market that's 5 times the size, provided there's enough capital that can be allocated towards it, and maybe long-term prices aren't multiples of where they are today. Maybe they are much higher than, or even slightly lower than the 13,500 or whatever long-term than where they are today. But that doesn't mean that companies can't see exceptional top and bottom line growth through increasing their production. Something like vanadium, however, you know, if we do get a big uptake of vanadium redox batteries, where is that primary supply going to come from? It's really hard to tell because there just aren't the primary deposits identified. So those potentially large demand bursts can see huge shortages and big price spikes, just like we've seen in the past in vanadium itself, as well as other commodities. So, you know, I think there's a clear distinction within this overall changing demand paradigm as to how the commodities, how the miners can react through the relative scarcity of the metals themselves.
Yeah, excellent. Will, do you have a view?
Well, I think I know Michael might know of a very good value Cobalt company, and I wouldn't disagree with him there. No, I think if you take a snapshot today at today's prices, then you could argue historically that some of them are maybe looking expensive. But when we roll forward to the market that we know is going to grow, because we know the customers have the capital to grow this market, then I think a lot of them are really screening quite attractive on our models, certainly.
Yep. Okay, that's good to know. Well, that's taken us to time, and I think that's quite a good note to end it on. Lots of challenges, lots of capital still to come into the sector somehow, but at the same time, some great opportunities in this big global energy transition. So thank you very much, gentlemen, for contributing your expertise and helping to shed some light on some of those tipping points within the industry. So cheers for your time, and thanks for contributing.
Thanks, guys.
Thank you very much.